In this next podcast for CraftBeerFinance, we want to look at how you can take the income statement and balance sheet and try to create a measurement of of how cash flows are occurring. In other words, the big question we want to ask is, using the income statement and balance sheet, how can we identify how much cash has been generated by the company, but also what are the sources and uses of that cash? Recall the example of the craft beer distributor, or actually the craft beer company, with the cash receivables and so on for both the 2 years from one of our original podcasts. The big thing we want to ask here is, if you look at the change in the cash account, 100 in 2013 to 110 in 2014, it's increased by $10,000. But a bigger question is that simply because of greater income, or have there been other uses and sources of it that we need to identify? If we look at the income statement, you'll notice that the earnings after tax were 100. Recall, or based on your accounting background, that the income statement isn't necessarily a true indicator of cash flow, because there's timing differences, because you have to bill your clients and you get billed by vendors and employees. So when the expense occurs, it doesn't necessarily tie into when the cash is received or paid. But in this case, the cash account on the balance sheet only changed by $10,000, yet we earned $100,000. We know 50 of it went to dividends, but what happened to the other 50? There's a $40,000 difference. We want to know where did that money go to? What we're really trying to first get at is the operating cash flow. In other words, based on the operations of the company, are we generating enough cash flow, taking into account timing differences? Kind of the broad way of measuring it, you can see cash from operating activities is typically revenues minus the operating expenses, including depreciation. You'd subtract out taxes, add back depreciation if that's been included in operating expenses, because that's not really a cash expense. And then you calculate how much cash is being absorbed or created by the change in working capital. In other words, maybe our inventories are going down, that's creating more cash flow, or other examples. And that gives us, we call our net operating cash flow. If we look at the example of the craft beer company and tie in their income statement and balance sheet, we'll see that, okay, sales, operating expenses, subtracting out all those items, adding back depreciation, and subtracting working capital, we actually created operating cash flow of $170,000. Now this differs with the earnings after tax, which was 100, and definitely the addition to retained earnings, that was 50. So we're actually generating more cash from earnings that aren't necessarily, or from cash flow from operations that aren't necessarily reflected in the income statement. Primarily that's coming from, a lot of it's due to depreciation and also the working capital. Other areas we want to look at is not just cash being used or created by operations, but also what we also call investment activities. In other words, the amounts that we're spending on capital expenditures. In the craft brewery standpoint, buying that big boiler or that big piece of equipment, that new building, whatever, that might be a significant amount of money we're spending. And again, that won't show up in the income statement except if we depreciate a little of it, because the cash is being paid, but we're not actually expensing it except over time. Also, some people might be buying companies, acquiring other craft brewers, and that could be a source of or use of major cash. Finally, the other area we get cash from or can we spend it is the things like, we call it cash from financing activities, which can be in selling or rebuying our stock back, paying off debt, the dividend payments, and so on. In our company's example, you notice that we had net borrowings of short-term and long-term debt of $50,000. We compare the balance sheet years between 2013 and 2014. The difference between those two would have shown an increase of $50,000, meaning that created cash for us. We had to pay some interest expense, which came right off the income statement, and also the dividend expense from the income statement. And so cash from financing activities ended up being a negative $40,000. So we created cash from operations, which included depreciation. We spent some on fixed assets and other things, but we also spent some money on our financing activities. So if we look at it all combined, you can see that Cash from operations was 170 plus. We spent 120 on capital expenditures, mainly the fixed assets. But then we had that 40,000 that we did from paying the dividends, offset by borrowing some money. So net effect, that's how we explained what our cash flow was. The $10,000 can be explained by created 170,000 or generated 170 from operations. We spent 120 of that operating cash flow for capital expenditures, and we also spent a little bit on dividends and interest payments, partially offset by borrowing more money. What this does is it gives both the reader of the financial statement and management kind of a better indicator to find out, hey, we've been making money, but we've been making a profit, but where's that cash? We don't see the cash flow coming in. Or vice versa, we've been losing money, losing profit or showing net losses, but yet we have great generation of cash flow. This report, the net cash flow report, shows us the sources and uses of cash.